Welcome back. Thank you for supporting us as always. The Chicago Malaysia group thanks you for joining us. We've got Ben from Chicago Global, who runs the Quant fund in Singapore. If you need to reach out to him, feel free to buzz us after the session. We'll definitely link you up. His quant fund is called Chicago Global. He's also a professor at National University of Singapore as well. Anything that's related to finance, you guys can talk to him. On the other side, from Malaysia, we've got Peter. Peter comes from an interesting background. Used to work for JP Morgan, studied at Harvard.
Morgan Stanley, actually.
Oh, sorry, Morgan Stanley. Morgan Stanley. He's
Another
also
Morgan.
a White House presidential candidate scholar as well. Went to Harvard, so I'm always super impressed with Peter's insights on macroeconomic side and also the quant fund side from Ben. So without further ado, I think this is our standard session. Basically, we are starting the session now. We'll have the guest presentation. I'll let the session run as long as you guys are interested in, and I don't want to cut the speakers off because we're discussing some really interesting things. So time limit could sometimes put some pressure on and just run through. So I won't do that. I'll let the speakers continue. At the max, I think it would probably be an hour 15 minutes, maybe an hour 30 minutes. Apart from that, we'll have a Q&A session towards the end where you can ask the speakers those. I did the quick intro here to the guys. We started off with this last week, and I think we talked about a whole bunch of items in terms of how central banks are reacting, what kind of recovery are we talking about, whether it's an L shape or V shape. Peter was in the Malaysia chat group said, I want to coin a new term called the K-shaped recovery. So I don't know what this is this week since we've actually talked. It could be something completely different now as well. We've also been seeing a lot of things online, in terms of free money. The rescues are basically ruining capitalism. On one side, it is actually creating a huge disparity between the rich are getting richer and richer and richer, and the poor are getting poorer and poorer, where daily wage is becoming a problem. COVID-19 continues to pressure every country, every location on earth. Of course, with the Lebanon thing, you guys saw the latest thing that happened with the blast and how the government actually came down because of the economic crisis combined with mismanagement as well. Without further ado, let me hand you over to Peter to start the session. Peter, the court is yours.
Thanks, Anand. Hi, everyone. Thanks, Ken, for joining us. I'm glad that you found our content interesting enough to request part 2 of this seminar. So we'll pick up a little bit where we left off last time. And what I thought we could do is just maybe talk a little bit about what are the consequences for the economy and the society as a whole of the extremely loose central bank policies that we've seen over the last few decades, and then drill down a bit more micro. What are the consequences for the investors, and what does it mean for valuations? What does it mean for earnings? And then what does that in turn mean for potential investment approaches? Obviously, anything that we talk about in terms of investment approaches would take with huge grains of salt, because anyone who tells you that they know what the even near future looks like, it doesn't know what they're talking about. So, but we will try our best. Just to pick up where we left off last time, I talked about the history of the central banks and the extreme loose monetary policies, which had then combined with deregulation resulted in extreme levels of debt that we see across the world, really. Obviously in developed countries like the US, but obviously as well in developing countries such as China. And this is debt at all levels, whether it be government, corporate, or consumer debt. So one of the interesting sort of consequences of these expansionary bank policies has really been, as we discussed last time, the decrease in productivity growth. So that's dropped substantially. and has really then led or been sort of transmitted through the financialization of the economy. So you'll see in many cases, companies around the world have found it either too difficult or not productive enough to do actual real economy investments, and hence they have used their cash balances, and oftentimes cash balances that were acquired through levering up of the companies, instead of doing capex or investing in their employees and human capital. They've been doing share buybacks, for instance. So that's one of the key elements that we've seen that has been a direct result of the loose monetary policies. Likewise, private equity has become more and more important in recent decades, and private investors have been able to achieve extremely high equity returns, primarily through ever-increasing levels of cheap debt. And not only cheap debt, but obviously privileged debt as well, because in most jurisdictions around the world, debt is tax deductible and hence is privileged over equity from that perspective. And so there's been larger and larger buyouts, which obviously there's clearly in some cases operating improvements, but research has shown repeatedly that vast majority of the returns that private equity investors deliver to their funds are through the use of high leverage. So when you have shocks such as COVID-19 that hit the economy, then obviously some of those very high levels of debt lead to bankruptcies, which is something that the central banks, as we've seen, as well as obviously governments, are keen to avoid. And in many ways, then these central banks and governments then bail out the private equity investors. So what you have, in a nutshell, and we'll see this theme over and over again, is you effectively have what's been called capitalism for, or rather socialism for the very wealthy and corporations, and capitalism for everybody else. Now, there's also obviously a broader issue of misallocation of capital and credit across firms and industries. Obviously, what happens is when the cost of money and cost of debt specifically nears zero, there is less of an investment discipline that's being enforced. And so that clearly then leads to investment across the economy in projects and or companies that may not deliver productivity growth in the future. On the flip side of that, the easy availability of debt and the low cost of servicing that debt results in certain companies that should go bankrupt, and these have been broadly termed zombie firms. So these are companies that cannot even cover interest payments out of their cash flow. And those companies that should go bankrupt and should, essentially through, creative destruction, lead to redeployment of that capital to productive uses, but instead are effectively, sucking that capital and again decreasing productivity growth. By the latest estimates in the U.S., for instance, 20% of U.S. firms can now be classified as zombie firms. So that's an all-time historical high. And then finally, the last element that contributes to the slowdown in productivity growth is harmful economic concentration. So here again, we have a confluence of loose central bank policies and government deregulation causing larger firms effectively to have the ability to get larger and larger because they obviously have privileged access to the debt, as well as an army of lobbyists that can lobby for regulation or deregulation, as it may be, that is beneficial to them. And so you see this obviously most importantly and most clearly in the US tech sector, where there's extreme economic concentration, by the likes of Amazon. So, Amazon, for instance, had recently, as you may have seen, issued debt at all-time low percentage rate for a corporate issuer in the US. So this is a way that larger companies can increase economic concentration at the expense of smaller companies who do not have such access to the credit that's being doled out by the central bank. And over time, obviously, such economic concentration has been proven in history, as well as obviously through research, to be harmful to the economy as a whole. Now, some of the other things that are resulting from the central bank and government policies are, without a doubt, increased fragility of governments, households, corporate balance sheets. And so this overall system brittleness, everything essentially becomes too big to fail. It's something that we've seen again when it came to the shock from COVID-19. Virtually very few households and no corporates, or very few corporates, had any sort of buffers to be able to deal with this shock. And far from it, they had, many of them had large balance sheets that, with the amount of leverage that they had, clearly made them very likely to fail. What you saw, obviously, is the Fed, again in the US, but also central banks and governments around the world, stepping in to rescue everything and everybody. So the problem is, clearly, as I'm sure hasn't escaped most of you, is that if you cure extreme levels of debt with even more extreme levels of debt, which is what we've done across the world following the great financial crisis, well, doesn't take a genius to figure out where that leads. So that is, the overall concern, and what you have then potentially, that's currently being discussed, I think across the investor spectrum, but also, from economic research, does all this, finally lead to inflation? And that's, I think, a very, very difficult question to answer, and it's not something that I will try to answer in this particular seminar. However, I think one thing I would say is that there clearly has been inflation, and has been fairly extreme inflation over the last couple of decades at least, and the inflation has been in asset prices, not in consumer goods. So just because we decide one inflation is good and another type of inflation is bad, that doesn't necessarily mean that there hasn't been inflation. There certainly has been inflation. The money and the debt that's created has to go somewhere, clearly, it, rather than going into the pockets of the masses, as had happened perhaps in the 1970s and in earlier periods of inflation, and hence causing inflation in consumer prices, it has gone into the pockets of the very wealthy, and hence, because the very wealthy obviously cannot spend a large proportion of their wealth and incomes, it has therefore gone into inflating asset prices, and that's not just stocks, but obviously real estate, as well as other asset prices across the world. And so this has obviously then led to dramatically increasing wealth inequality, and so that is one of the key issues, that we're facing as a society globally, really. And I'm not going to go through the statistics. I think it's fairly clear to everyone. But we are probably at wealth inequality that we have not seen in at least 100 years. And if you look at some of the research that Ray Dalio has done, for instance, the extreme levels of wealth inequality that we have today around the world, really, in most countries, has inevitably and almost always historically led to very, very destructive and negative outcomes. So I'll leave it at that. But I think that's one of the key issues, and it's really really a self-reinforcing spiral in which the very wealthy obviously do influence government and central bank action directly and indirectly to ensure that they become wealthier and wealthier. And that is kind of the downward spiral that we've been in. And clearly at some point it will become very problematic. Finally, the impact on the overall investment environment and the capital markets, especially with the latest actions of the Federal Reserve, but obviously also going back several years through the actions of the Central Bank of Japan, as well as the ECB, is that increasingly the price discovery mechanisms have been completely broken. So I think it is now, a fairly well accepted thesis that asset prices in most, if not all, areas of the capital markets are what the central banks want them to be. And that obviously, is a very dangerous road to go down because it sort of removes the central tenet of the capitalist system as well as the central tenet of capital markets. And we all, as graduates of University of Chicago, should be very, very concerned when there are steps that central banks have taken to effectively eliminate the price discovery mechanism within the capital markets and replace it, with their own heavy-handed action. So with that, before we go, talk a little bit more about then what are the impacts specifically on equity valuations and multiples and earnings. Is there perhaps something that you want to add to that sort of overall introduction from the Asian perspective, Ben?
Well, maybe before, thank you, Peter, and thank you everyone for joining in for part two. So I think you did a fairly, Peter, I think you did a pretty good job picking up kind of close to where we left off last time, but let me put things into a global context. So I think most of what Peter said is right for the United States. There are several issues with some of the facts that you had, but we could go into detail later. I do think that broadly speaking, one of the key things of consideration when we're thinking of a global context is we should ask ourselves, as people who are in Singapore or Malaysia, right? These are effectively small open economies, right? And one of the tenets of small open economies is there's not so much scope for a lot of monetary policy, right? So what does that mean? It means that many of these small open economies are highly dependent on the monetary policy of larger economies, right? And so that's why, I think Peter makes a good point that we need to focus quite a bit on what the Fed and the ECB and the Bank of Japan are doing, because that can propagate to affect, very real outcomes where we live as well. So I think there were several themes that Peter mentioned, which I just want to add a little bit more clarity on. So number one is about market concentration. Certainly that is true. right? And if policy is designed to actually make market concentration worse, we see some weird things in the market, right? The implication of higher market concentration is that shareholders get more rents, right? So if you remember Microeconomic 101, perfectly competitive market, net of cost, companies actually make zero profits, right? And when you get more concentrated, they exercise market power and they start to make more profits. What that means is you can actually end up getting pretty good returns as a shareholder, right? Then the cost being you're introducing dead weight loss into the economic system. In order to generate $1 of excess returns, you're taking away more than $1 worth of welfare in the economy, right? So that's the inefficiency that we think of in terms of the efficiency of the economic system. I think, given where the markets are today, there's certainly a lot of concentration, and market concentration by itself doesn't mean that the market is not competitive, right? But there's certainly signals, and I want to bring up one of my colleagues. He is a professor now at the London Business School. We finished out of the finance program at the same time. Simca Barkai, he has some work documenting the rise in market concentration around the world and the rise of firm profits around the world. And he ties everything back to a key time period in the 1980s with the Reagan administration. That's when there's a lot of deregulation. Suddenly you got a lot of mergers and acquisitions, right? So for those of you who've lived through that, that was a great time to be in finance or private equity. And as Peter said, that was one of the good times for private equity where you just lever everything up to the eyeballs, right? And you just flip the company, and that drove a lot of PE returns. Now, we're living with the consequences of those actions today. The FTC has been quite effectively handicapped. They have not brought a lot of high-profile anti-monopoly cases apart from a handful that we can think of, such as Microsoft. That was a big one. So the recent discussion, right, with the big four tech companies, there's Apple, Amazon, Facebook, and I forget what was the last one. Maybe you remember the name, Peter, but they actually went to testify in front of Congress to justify, right, why they deserve to be so big, right? Interestingly, these big companies are trillions of dollars in terms of valuations, and yet they're continuing to drive returns, right? There's some notion in which in a world that's driven by data, the more data you have, the better the returns are. So actually data can actually create what is called increasing returns to scale for companies. So the natural size of the optimal efficiency size of these companies might be bigger than what it was in the past. But something definitely worth thinking about is what is quote, quote, big, optimally big, right? And whether or not we're past that stage. There's certainly some sense now, and I think Peter will agree that, for people who are considering investments, if you have a highly concentrated portfolio, and increasingly the stock market itself is becoming a more concentrated portfolio, and you're allocated to a lot of these big tech companies, then effectively you are making a bet on regulation, right? That if any time the FTC can actually come back and gain back their weapons to actually fight back against these big trusts, right, then the returns for those companies will be pretty bad. I think we do have to acknowledge that, all of us coming in through the University of Chicago, we are benefactors of large companies, right? We wouldn't be here without John D. Rockefeller. And at that time, they came after him, right? Standard Oil was broken, I think, into 9 or 11 companies. And then after the 80s, they started consolidating back up again, right? And so now I believe there's like 3 or 4 companies that are remnants of those. So that's definitely something to think about. The second point is the misallocation of capital. And I would tie this idea together with something called the financialization of corporations. So what we're seeing is rather than making real investments, building new buildings, right, doing R&D, we see companies do M&A. You see companies buy back their shares. And so actually share buybacks, increasingly, that is less the case than it was maybe last year, but even then there's quite a lot. Now, what that signals to the market, or what it should signal, is one of two things. A, either management thinks the stock price is undervalued, right? And they're trying to send a signal by buying the shares, or B, they're running out of productive real investment opportunities. Okay, so it's one of the two. So if you think that the share buybacks do not reflect Google thinking their shares are underpriced, then it should signal that maybe they don't have available real investment opportunities that would actually beat the investment of just paying the cash out to their shareholders. I think that's certainly something to keep an eye on. You know, I started doing some research on Japan several years ago, and at that time, people kept asking me, why study Japan? Japan is unique, right? They've been unproductive for decades, and they have a bunch of corporate governance issues. Bank of Japan has a bloated balance sheet. That'll never happen in the other countries. And I think increasingly, we are certainly going down that path. And the issue with Japan is, as Peter mentioned, there are these zombie firms, right? Firms that are highly levered, and they cannot produce enough cash flow in order to stay alive without the support of, in some sense, the central bank, which keeps rates really low. That is, if interest rates increase by 1%, we would see vast swaths of these companies go bankrupt. So I have a couple of fairly active Twitter discussions with other faculty members from other universities on what could be done in the COVID crisis. And my stance has been that one of the things to focus on is bankruptcy reform. So actually, rather than try to keep these companies alive and bear the potential costs of these zombie firms, which generates huge amounts of what we call debt overhang and misallocation of capital, just help firms die quickly, right? You just wipe the shareholders out and reset the firm. Right? Hertz is bankrupt doesn't mean that they stop business, right? The creditors just become shareholders. Interestingly, Hertz was still able to raise some money despite being bankrupt, which is a new case in history. But I think that's certainly something to keep an eye out for. At some point in the long run, it must be that financial markets and the real economy have to converge. If not, you're in a Ponzi scheme. Right? And maybe, we can debate as to whether or not we think we're in that world. But if we are in a Ponzi scheme world, it's for sure not sustainable, right? Just by definition. And I think we'll talk a little bit more about that. The third point that Peter brought up was the issue of inflation. I want to push back a little bit on that because it's the term gets used, inflation is typically tied to the price of goods and services in the economy, right? And then there's asset price growth, right? I tried to not think about that as inflation just because I don't want to conflate the technical terms. But certainly part of having low inflation on goods and services can actually sustain high levels of valuations, right? So if you set up a company that has zero cash flows today, but it's going to generate cash in 10 years' time, however, the price of $1 today is still worth $1 in 10 years' time. Suddenly, the value of the future cash flows seem a lot bigger, right? And if ever the value of money drops, then suddenly valuations can turn really fast, right? And so if we're driven in a market where a lot of the returns have been driven by firms without strong fundamentals or fundamentals that are in the future, when we talk about inflation risk, right? Slight changes in inflation can certainly make the valuations unsustainable and can quickly correct. I'll be a little more forceful to argue that I do think that inflation, not only will it come back, it has to come back, right? There's some sense in which, given the decision of current fiscal policy, if there is no inflation, the government actually may not have a way to pay down their debt. Right. And so then you have several options. You try to get inflation to tax people that way, or you default. And I don't think there's any realistic state of the world where the United States defaults. So I'll hand this back over to Peter to kind of pick up stuff related to the asset market. We have already some questions in the Q&A, Peter, that maybe you could address as well.
Sure. I'll just take a quick look, see if we have anything before we get... All right, gold.
The couple of questions. The questions are from Arun, and I think Pedro Pedro is asking, is the gold rush we are seeing in the recent weeks sustainable?
Okay, well, let's maybe talk about, I'm just checking to see if the questions are kind of macro or micro, then they seem to be more micro. So let's cover kind of the overall background on, what the impact on the actual equity valuations is, and then we can also talk about, currencies and commodities and gold as well. But let's kind of go through a little bit high-level overview, and then we can dive down into and answer some of these questions that have come in. So, one of the key things that's obvious, I think, to everyone is that obviously valuations and changes in valuations are not evenly distributed over a certain time frame. And so what that means is if you have very high multiples in the presence, everything else in the present, everything else being equal, future equity returns are likely to be extremely depressed or negative, unless there is effectively a change in the E equation, or in the cash flow or earnings equation of the multiples. So that's kind of, I think, the overall environment that we're in. We are in effectively an environment where in the real GDP in developed world has hardly moved over the last decade or so, really. It's been extremely slow recovery since the great financial crisis. A little bit better, in places like US, obviously very bad in Japan and the Eurozone. But overall, in developed markets, it's been arbitrarily close to zero. And on top of that, whatever growth there has been, I think arguably has been achieved primarily through increasing debt load. So you'll see that, as we discussed last time, the debt levels, not so much on the consumer side, where it's been sort of stable, it's been down and then stable and slightly up. So now we're probably somewhere slightly above where we were in 2007 across most countries. But certainly on the corporate side, debt levels have skyrocketed, and as well as on the government side. Problem is that, as we discussed last time, these additional debt that has been raised has largely not been invested in growth and productivity, as we've discussed, but rather in what Ben referred to potentially Ponzi scheme type moves by various companies to juice up share prices in the short term. Additionally, I think another problem that we are kind of seeing the result of these days is excessive profit harvesting. I'll just term that phrase. And what I mean by that is that there's been historically low levels of investment in R&D, CapEx, and human resources. So if we'll take a look at across the developed world, how much are companies reinvesting of their cash flows into these growth areas, it's been by and large very, very small amounts. We've also seen exploding levels of earnings manipulation, both what I would call legal and acceptable. So if you, as an example, if you for instance take a look at Uber's definition of adjusted EBITDA, it runs to about 15 lines from the latest quarterly report, and it's gotten to a point where it's kind of viewed a little bit as a little bit as a joke by the analyst community. But then you obviously have kind of some cases such as WeWork, where it's sort of halfway between acceptable manipulation and fraud, and then obviously a number of cases of outline accounting fraud, such as the recent case of Wirecard in Germany. So that's been something that's also been kind of artificially boosting earnings over the last couple of decades. The third or fourth element that's been artificially boosting earnings and cash flows in this case as well is ever decreasing tax levels. So, what we have, in the U.S. and other places is there's been, effectively a arms race between jurisdictions as to, which jurisdiction will tax corporations the least. And that's kind of led to ever increasing cuts in corporate taxes, as well as increasingly brazen efforts by corporations to evade taxes in the jurisdictions where they operate through, various very complex tax structuring methods. And then, at some point, and I think we are at that point currently, that obviously becomes unsustainable. So I would argue that we probably are, globally at the nadir of corporate taxation. I would argue that post-COVID-19, I think across jurisdictions, corporate taxation will start increasing. I'm not sure if we'll see kind of the levels of post-World War II, 50+% tax rate, but certainly we will see increases, and that will cut into future earnings flows, earnings streams, and cash flows. There's also, as Ben had referred to in more detail, there's been some would argue oligopolistic pricing power, increasing economic concentration due to low levels of government regulation, especially in the tech sector. Again, that has led to disproportionately high growth in earnings artificially, and there's some signs that that will also come to an end. I think there is definitely some talk, especially in the venture capital community, that governments around the world will sort of step in and try to break up some of the oligopolies that have established, in the tech world. So, we'll see. But again, we are likely probably at a level that is probably historically, low in terms of regulation. And then finally, and this is something that not a lot of people talk about, but I think again post the COVID-19 shock has become more and more of a discussion point, which is the proportion of value in our society flowing to capital versus labor. And so this is, one of the biggest macro metric that you can take a look at in terms of, what is the power balance between, capital and labor in various countries. What's interesting is, that's something that has been decreasing pretty systematically since kind of the 1970s, 1980s across most developed world. And we are at a point where the proportion flowing to capital, i.e. and translating into earnings and cash flows for companies and investors, has reached levels that we have not seen, in the last 100 years or so. So, there's a good chance that through various social pressures as well as, government pressures, that proportion will start, mean adjusting and shifting back towards a level where you'd see more value flowing to labor, which obviously will mean that there's going to be less of the value flowing to capital, and hence low earnings and lower cash flows. So just to sum up this whole discussion, in terms of future earnings and cash flows and growth thereof, even putting the whole COVID-19 shock aside, I am relatively pessimistic in terms of the overall earnings and cash flow growth for publicly listed companies, especially in the developed world. Now, obviously, there's very large differences between, if you look at, something like Amazon or Google and, or some of the more old economy companies. But overall, if you look at, let's say the S&P 500 as a whole, I find it difficult to believe. First of all, I think it's going to take several years, 3 to 4 years probably, to even reach 2019 levels. And from there, I think it's going to be very, very difficult for that earnings stream to grow at the rates that we've seen over the last decade, which have in turn been massively disconnected from the underlying GDP growth. So that kind of covers the earnings part of the equation. Now, if we focus on the prices, the multiples, again, I'm not going to go through this in a lot of detail because it's in the press and sort of in front of all of our faces on a daily basis. But clearly, multiples are at pretty much all-time historical levels. I think depending on what metric you look at, multiples and valuation levels have now exceeded the 2000 bubble, the pre-2000 bubble, dot-com bubble. And, I think there's definitely growing consensus among institutional investors that equities and for that matter, virtually all assets are dramatically overvalued. And, the issue obviously on the flip side is that people keep putting more money in because, as the phrase goes, Tina, right? There is no alternative. And if you look at it from the 30,000-foot level, what I like to use is the Buffett indicator, and that's Warren Buffett, not Jimmy Buffett. But if you look at the U.S. stock market capitalization to GDP, it's now at somewhere over 160%. So this is, the indicator that Warren Buffett likes to look at to understand the level of disconnect of the equity market versus the underlying economy. This peaked for the first time at 110% in 2006. So, we are now 50% above the pre-GFC levels. And then even in 2000, pre-dot-com bubble burst, that peaked at 140%. So I think these are numbers that are important to keep in mind, right? 110% in 2006, 140% in 2000. Today, it's over 160%. On the flip side, at the trough of the great financial crisis, that number was 56%. So we are at 3x, 3 times where we were at the trough of the great financial crisis. So that, I think, is something that should give everyone certainly a very, very long pause for concern. If you look at virtually every other valuation metric, I think they're all at or near historical records. But I read all the various equity research. Obviously, equity research analysts always try to bend themselves into pretzels, trying to figure out how to justify the current levels of valuations and predict future growth, because that is the business they're in. But I can tell you, looking at the research out there, I have not seen so many sell recommendations overall as I've seen in this cycle. And that's even though, again, the research analysts have been really twisting themselves into pretzels. I've seen things, I think Goldman has recently come out with looking at PEs 36 months out, right? So it's not NTM, this is NTM 36 months, 3 years from now. You know, I think when you see attempts such as those, I think, again, it's a cause for a lot of pause, if you will. If you look at the tech sector specifically, and, you know, I know everyone says, of course, you know, this time is different, and, you know, there are certainly, you know, a handful of tech companies that are different, that, you know, are some of the behemoths that we talked about, you know, Microsoft, Amazon, Apple to a lesser extent. But, you know, having said that, I would say that there are few and far between. The companies that are actually making, you know, substantial profits are few and far between. They are very much concentrated in a very narrow slice of consumer tech. When you look at outside of that narrow slice, it's a pretty ugly, you know, it's a pretty ugly outlook out there. I mean, for instance, if we take a look at Tesla, right? You know, Tesla, if you subtract the various government subsidies, has never made money. But yet, its total market cap is now, you know, close to approaching the combined total market cap of all other listed car companies in the world. I mean, if that's not a definition of a bubble, you know, I don't know what is. If you look at the actual numbers, the NASDAQ 100 is, I think, at about 3.4 times, 3.4x of the S&P 500, which is equivalent to where it was at the peak in 2000. So we've reached the tech mania peak of 2000. And let's not forget that following the crash, that ratio then collapsed to 1x. So, you know, dangerous time for the market as a whole, but certainly very dangerous times for valuation dispersion. And what's very interesting is that you are seeing, you know, this value, and we'll talk about that in terms of what, you know, what maybe some potential ideas on how to trade these markets. But you know, there are clearly the overall equity market is you know, highly elevated in terms of valuations, but there are also historically extreme dispersions between both U.S. markets and non-U.S. markets. So if you look at, for instance, the U.S. stock market is at an all-time record of 2.4x of other developed markets. That has been historically averaging about 1x. So we are, you know, the U.S. stock market is, you know, more than 2 times more expensive than non-U.S. developed markets versus as the historical average 1x. And then also within, you know, especially the U.S. stock market, but also globally, but certainly within the U.S. stock market, there's been an extreme valuation dispersion. What I mean by that is that, as I said, while the overall markets are extremely overvalued in the U.S. especially, the highest multiple companies are even more disproportionately overvalued. Right? So if you look at the likes of Tesla, for instance. Now, what's interesting, so Goldman's done some research on this, and they've looked at it across a number of different valuation metrics. The one I found particularly interesting was the PEG ratio, right? So that's the PEG ratio, as I'm sure all of you know, is basically P divided by long-term growth. So that is sort of, you know, obviously it has its flaws, as all valuation ratios do, but it's a very simple way of kind of adjusting for, you know, the growth factor that is usually brought up as a defense of why some of these tech companies trade at the valuations they do. So this, in theory, should adjust for differential in long-term growth expectations. So what is interesting is that the lowest quintile of the S&P 500 trades at a 2x PEG ratio, which already is quite discerning, very concerning, because I still remember back when I was a young buck trying to learn how to invest, and one of my mentors, told me that the only thing you need to know is never invest at a company that has more than 1x PEG ratio. So obviously that is something where you wouldn't buy anything ever these days. But what's interesting is that the lowest quintile is 2x PEG ratio versus the highest quintile is 5x. So this is a difference of 3 turns, basically, 2x versus 5x between the lowest quintile and the highest quintile. Now, theoretically, again, if you think about it, the PEG is supposed to be adjusting for growth, so there should be generally similar PEG ratios, across the market, more or less. When you have a dispersion of 3 turns, very concerning. According to the Goldman research, the historical average has been 1x differential, so 1 turn differential. So now the differential is 3 times as wide as it has been as per historical averages. So, then the question is, how can these multiples effectively revert to historical averages? I mean, I think there are clearly a few scenarios. Very simply, you could have potentially real earnings growth that is so enormous that it closes the gap, based on some of the factors that I had mentioned earlier. I find that very, very, very difficult to believe. You could also have potentially nominal earnings growing tremendously. That's obviously called inflation. So, as Ben had referred to, that's a possibility. I don't think anybody really knows. It's a very difficult nut to crack. But, we may have sort of stagflation type scenario, such as in the 1970s, where even though, the actual real earnings stay the same, nominal earnings grow because of inflation and close that gap. Or you could have potentially the multiples staying elevated perpetually, for the long term. Perhaps it's very unlikely, based on historical precedent, but anything's possible, I suppose. And then the fourth and last scenario possibility is that the prices will basically drift down or collapse down to mean revert to somewhere where the valuation multiples would start to make sense. So I think those are, broadly speaking, kind of the 4 different scenarios that we may be looking at. Now, obviously, this is just specifically focused on equities. I think there's been some questions from Pedro and others about gold. I think it's a very, gold is obviously an enigma. I think it certainly does have a place in every investor's portfolio, just from a perspective of diversification and some inflation protection. Having said that, if you actually look at the research, interestingly enough, gold has not been tremendously useful against as a protection against inflation. Maybe going forward, but with any other investment, what matters is obviously your entry point, right? So with gold at $2,000 an ounce, it's difficult to obviously we talked about equities where valuation is already difficult, but certainly there's set analyses that you can run. When you look at gold, as they say, the value is in the eye of the beholder, right? Gold doesn't produce any sort of cash flow, so it's very difficult to value it. There are certainly models that I've seen where analysts look at what the real interest rates in the economy are, supply demand of gold, jewelry demand, et cetera, supposedly based on those relatively complex algorithms. Gold is at this point overvalued anywhere 20 to 30%. That's, I'm just passing it on. I don't really have an opinion on that one way or another. So what does it mean? Where will gold go going forward? It's very difficult to determine. I think it's, again, I think is the rally sustainable? Depends on a lot of things. I think there will be, a bit of a pause, certainly in the short term, because it's run up a lot in a very short period of time. So I would say, if you don't have any gold in your portfolio, certainly try to take opportunities to add gold, as and if there are sort of dips in the valuation going forward. Okay, second question, what's the implication on dollar with the unlimited spending? So, I mean, again, so this is a very interesting question because what we haven't really talked about, because I was focused primarily on the Fed, is that all central banks around the world have, to some extent, been engaging in the same extremely loose monetary policies. And what's interesting is that the Bank of Japan and the ECB have actually been more aggressive historically than the Fed, right? So, for instance, if you look at the purchases of corporate bonds, the Bank of Japan has been doing that for years, and the ECB as well. So, the Fed was a little bit late to the party. Bank of Japan has been purchasing equities through ETF purchases for years now. I think the latest stats I've seen, I think the Bank of Japan actually owns something like 80% of the Japan ETFs, which is, absolutely insane. So,
I have a paper on that if you want to get into details, but that's right.
Yeah,
80%, about 5% of GDP.
Yeah, I mean, it's completely insane, right? But, they have been, and it's been, maybe a little bit quiet. So that's, what's interesting, I think, is that there's been a term kind of bandied around during the great financial crisis of, the dollar being the least dirty shirt, meaning that all the major currencies are, effectively being debased at, rapid pace. And in fact, what's a little bit, well, not more than a little bit concerning, is that many governments around the world have kind of switched from a view where strong currency is preferred because indicates, it's a strong economy and, strong government, to a scenario where each government and each central bank is actually trying to devalue the currency against the other. So I think there is definitely a consensus among most of the major governments and central banks that they prefer weaker currencies. And so we are in some ways getting into kind of the interwar period that we see between First World War and Second World War, where there's almost a race to the bottom of competitive devaluation. So Where will that come out? It's hard to say. Having said that, the dollar is still today the undisputable #1 top dog in terms of reserve currencies, right? And if anything, the dollar's position has been strengthening over the last decade or so, surprisingly. So, just like with, what are you going to invest, and, you want to avoid high valuations, this is a little bit of a TINA trade, right? There is no alternative. If you don't hold the dollar, what are you going to hold? You're going to hold euros, ECB is as promiscuous as the Fed. You're going to hold pound, you're going to hold yen. What are you going to hold? You're going to hold emerging market currencies, which central banks can't really afford to, do the type of economic rescue that the big four can. So it's a very difficult question, and I can't say I have a strong answer on that. Having said that, the dollar is currently, certainly when you look at kind of at the depth of March, it was very overvalued. Even at today's level, it's against kind of historical averages and valuation ranges, it's somewhat overvalued. So I think there's probably some downside, but I don't really subscribe to kind of the hysterical, we are experiencing the end of the dollar, that we've seen kind of in the news over the last few weeks. And the third question is, what happens when multiple emerging markets default on their debt? Who bears the cost, and how does it impact the world overall? You want to take that, Ben? I think that's more down your road.
Yeah. So we can talk about the emerging markets, but it's worth thinking a bit about on the currency side. It is certainly worth thinking about what it means for your currency to lose value, right? Your currency, when it loses value against many things. So you have to pick the right comparison group, right? So as Peter mentioned, are we comparing the US dollar to the pound or the yen? Actually, interestingly, Japan, if they had not pumped or if they have not continually pumped yen into the system, their currency would actually continue to increase in value. What does an increase in value mean? It means deflation, right? So there are multiple ways to think along different margins, right? You have your currency with respect to goods. You have your currencies with respect to financial assets, your currency with respect to others. The issues with emerging markets not paying their debt, I think that's a big issue. Arun, I'll refer you to Professor Cheng Tai-she. This is not my area of expertise. He does a little bit more work in terms of sovereign risk. I'm happy, he has actually a Chicago Booth Review, like 2-minute video where he addresses everything very well. Broadly, the idea is just that there should be some kind of payment moratorium because some of these emerging countries do not have the capacity to borrow to actually stimulate the economy. And the cost is, if you don't stimulate now, right, the depth of the recession induced through the COVID and the lockdown can be worse. I do want to circle back to one point that Peter made, which I think is not correct. So it's certainly true that the US market in the level terms is valued fairly highly. And so, we're from the University of Chicago, so a good thing is to bring the data, right? So what I'm showing you here on the slide that Anand has kindly shared is on the left side, exactly what Peter said. That is valuations, looking at price to book. So this is academic style stuff done by Fama French. Currently, as of 2020 March, we're at the highest valuation we've been, all right, since 1967. So that's extremely extreme. So we're now actually at the new high. The part that I do want to push back on, and maybe I also am at fault with that because I like to mention the big tech companies, but the bottom line is it's not about tech, okay? If you create industry neutral spreads, that is within the same industry, say consumer goods, you look at the highly valued firms versus the low valued firms. That's the table I'm showing on the right here. It comes from AQR. They have an interesting blog called Is Systemic Value Investing Dead? Unsurprisingly, they have to write that because value has not been doing very well. But what you see is, I'll focus on the column called current percentile. That is relative to from 1967 until now, how high are we in terms of valuations? And we're not just going to look at one measure, we're going to look at multiple, right? Because you could always argue, yeah, this one specific measure is not perfect. So these are constructed industry neutral. So this is not tech, this is within tech. Even within tech, those really high valued firms are still much more highly valued than the low valued firms. Same thing is true in industrials, in financial services, in consumer goods, right? So this notion of overvaluation or these spreads between highly valued versus lower valued firms, or rather growth versus value, that spread is there even within industries. So what we see is looking at price to book, price to sales, price to earnings trailing, or even forecasted or composite. Almost all of those percentiles are at 100%, meaning we've never seen valuations this extreme. Okay, so it's not just an issue about tech, and it's not just an issue about the big 4 or 5 tech companies, right? It's actually a valuation problem that's there within industries as well. Now, the flip side of that statement is also that if you believe that value investing has something fundamental, it captures some fundamental risk or some fundamental behavioral problem, then you think that value investing is still a viable strategy. If that's the school of thought that you subscribe to, per Fama French, then it has never looked better. Literally, it has never looked better for value investors. Right now, the caveat is when value outperforms, it doesn't mean that value cheap stocks suddenly perform well. It could mean highly valued growth stocks are crashing, right? And that on net, the tilt is that a value tilt will add value, right? So we're talking about this from the long short sense. So from a long short sense, in terms of like a style of investing, value investing looks fairly attractive, right? Now, if you have been a value investor in the past 3 years, I'm sorry to hear that, because what that must have meant was that you have been hurting the past 3 years, right? As the valuations kind of worked against you. But on a going forward basis, for what I do for Chicago Global, we're a multi-strategy with a value tilt, right? So that looks attractive. I think Peter will agree that value is at least companies for which there is some fundamental backing that valuation, right? So long as it looks fairly reasonable, that can still be an opportunity, right? Because I do want to add that as the caveat as we're coming to the end here, because, we talked a bit about the unsustainability of the current regime, and I don't want the takeaway that you should step out of the market, because the issue is we don't really know. Expected returns on the market never turn negative. Average returns might, but the market's always expected to gain something, right? By definition, if not, none of the economic theory, supply and demand works. Okay, now, that's a weird world. So, going forward, it might be, almost mandatory to be exposed to the market still, right? Because the cost of stepping out of the market is extremely costly. On the other hand, maybe you want to think twice about investing in companies that have a lot of hype. So with that, I'll hand it back over to Anand. Peter, thanks for sharing your thoughts. I think you went quite in depth there. I have one more chart, which you've already mentioned, actually. It's about US versus the world. So if we could just flip to the next chart. It's exactly what Peter mentioned, right? Developed markets versus the MSCI ACWI All World Country Index. Again, since 1988 till now, at an all-time high. So it's the developed markets have never outperformed the global average global markets this much since the indices were launched, pretty much. All right, so I'll hand it back over to you, Anand.
Actually, that's interesting. So I have a question that's coming up here. So if you're saying that the valuation is quite high in the charts here, assuming that Russia announced a vaccine today, that they're testing a vaccine, and Putin's daughter's already taken one of those. What happens to the broader market when you actually talk about a vaccine that can really make an impact in the entire COVID landscape? I mean, the whole world, sort of takes a breather now. The sectors that were hurting suddenly sort of kick backs in. The sectors that are actually overvalued, the tech stocks must have been overvalued because everybody's buying that. Then what happens to this chart? Do you see a shift from moving to the popular stocks to the other stocks which have not performed, or would you still be looking at a broader investment scenario? Am I getting through?
Yeah, I mean, I think there's a threefold answer to that. Number one, I would take anything that Putin says with a giant boulder of salt, not even a grain. I mean, that it's complete posturing and BS. Number two, I think the best that we can hope for, based on all the research I've done on vaccines. Obviously, I'm not an expert in the area, but I read a lot of the academic journals, etc. And I think there's a fair degree of consensus, even though things are still moving around, that the COVID-19 vaccine is likely to be similar to a flu vaccine, right? So what that means is that number one, probably has something like 50-60% efficacy. It means that it's likely has to be taken at least every year. And it also means that, clearly the quantum that would be, required to be manufactured. So usually most of these vaccines are nowadays, seem to be 2 doses. So you're looking at, if you're going to vaccinate every human on Earth, looking at somewhere around 16 billion doses annually to be manufactured. I think I read somewhere that the total current manufacturing capacity for all vaccines of all types for the entire world is somewhere around 6 to 7 billion, right? So again, I think we need to kind of step back a little bit from the vaccine hype. And what I would say is that the vaccine is definitely not an end-all be-all. It's not black and white. At best, it's sort of going to be, shades of gray. Hopefully, we'll go from black to gray. But the coronavirus, COVID-19, will be with us forever. So I think the economies and companies and people will have to basically readjust and reconfigure to deal with the new reality. So that's number one. From an investment perspective, as Ben had mentioned, I certainly share that view. Personally, at least, again, don't take this as an investment advice, but personally, yes, when I, as a sort of quantitative and analytical person, I look at many of these charts and many of these dispersions, and even putting aside, the everything bubble that the central banks have created around the world. As Ben mentioned, we are in a TINA environment, meaning there is no alternative. You don't want to keep a large, amounts of your money in cash for obvious reasons, because all central banks are racing to turn cash into toilet paper as quickly as possible. So for that reason, you have to be invested, and if you have to be invested, maybe a good way to be invested is take a look at the things that are multiple standard deviations away from historical levels. So that's value, that's emerging markets, and that's non-US developed markets. And then hope that some sort of semblance of sanity settles over the market and people stop buying Tesla stock at $1,500 a share. And maybe one day they wake up and say, this is really, really idiotic. What are we doing? And let's hope that will happen, and that's what I'm betting on. And hopefully over time there will be a version or mean reversion to the mean, and hopefully it will mean that, you know, some of the beaten down, you know, value stocks and emerging market stocks will, you know, increase in value, and, you know, we'll get some sort of a return to normality. So that's what I'm betting on. But, you know, again, don't take it as a investment advice.
Just to close the session, I think this is a question for Ben. So from a quants fund point of view, we've seen that the government, I mean, today's topic of discussion was that there's so much free money, right? There's also excess capital. What happens to the actual valuations of currency in each of those countries? And how would you readjust investments from a quant fund point of view? I mean, I know it's not an advice that I'm asking for, but more from a holistic view. You know, each of the countries, like Asia is definitely performing better. They've actually reacted better as compared to the US or anywhere else, but also it's a much smaller population compared to India, China, US, South America, Africa, and, you know, different continents, right? How do you think your funds or larger hedge funds would react to or bet in terms of the free money that's flowing in?
Thanks, Anand. I think that's a fairly deep question. I'll give the framework, right? So on one extreme, when you're making investments for whatever it is, your company or your own portfolio, you have one approach, which is high conviction. That is, you do thorough research on the companies you're going to invest in, and you invest in a handful. Why? Because you simply cannot do thorough research for every company. On the other end of the extreme, you're piping in huge amounts of data, and that's closer to what Chicago Global is doing, right? In which case, it could be that we invested in some cheap companies whose fundamentals are about to get beaten down so bad they're going to go bankrupt, right? That's something called the value trap. Now, the approach with the larger number of stocks, more quantitative approach, what you require there is simply a statistical edge, right? It's about the number of bets. And so if you have 600 bets or 1,000 bets, right, some of them might go wrong. It's still okay if on average they tend to go right. So those are the two ends of the extremes. In terms of what you mentioned specifically in terms of currencies and equities, you know, there are certain, so I would say the bottom line for quant funds is you still have to take some stance as to what is the investment horizon, right? So am I looking for strategies that work on the day-to-day basis, on the minute-to-minute basis? So when I was at Citadel, the longest we ever held a stock was a week, and that was considered an eternity at Citadel, right? So in that environment, in that context, the current environment is great. The fact that there's a bunch of retail investors and people from Robinhood wanting to trade so much, that's great news because you can actually make the market and you can guess which direction they're going to trade. And you can make money off of that. Now, if you're investing for a longer horizon, right, so then the stuff that's going on at the day-to-day, week-to-week level might be a little more like noise. And so the question becomes, to what extent must you react to it? And so, you know, one of the things we spend a lot of time thinking about at Chicago Global is how do you separate signal from noise and what's the investment horizon, right? And so if we're doing a long-term investment, as Peter said, we can't afford to be out of the market, right? So the next best option is just to buy things with good quality and stability and defensive that has some potential for growth without being overvalued, right? Because that's kind of the approach that we take. And so there's certainly quant strategies out there that are trend following, which can pick up on the recent boom in gold and try to ride it out. But as far as I've seen, and it's been hundreds of these types of strategies, all trend following strategies are subject to crash, right? Because by definition, the trend it can't just go forever. At some point it reverses, right? So the name of the game becomes, can you time the crash? And the answer is typically no. So then do you want to participate in it? And I think that gets into a little bit more of a philosophical question, right? So if I have to manage other people's money, probably not. But for my own money, like I invested in Bitcoin and it's been fun, right? That's what that is, right? It's very clear that that kind of trading is not investment. It's betting, and that's been fun.
Gamble.
So I would say, for the people here, you have to make that decision, right? How deep of research you want to do versus how many bets you want to take, versus what's the opportunity cost, right? Can you afford to just sit on cash, even if that's what you want to do? And I think, every investor has their own needs.
Right. I mean, in fact, I think it's a perfect time to close the session. There was a latest report on Singapore. They said that they had not really covered the entire impact. And today's report said the road to recovery will be a longer path than anticipated before. So in that sense, I think, thank you, gentlemen. I think we could probably have a follow-up session 6 months down the line and see where we are at. And hopefully by then we have some sort of like light at the end of the tunnel to see corona's vaccines or any other form of readjustment to the entire globe of 8 billion people, right? With that, I think we can end the session. And thank you so much, Ben, and thank you so much, Peter, for joining us tonight. I would also like to sort of take this opportunity to sort of share our next upcoming session, which is hosted by Pedro, the Malaysia chapter's president. He's got some really big guns in this session. It's about corporate innovation, building the next wave of corporate innovation. We've got Dominic Fuda, who's the Group Managing Director and CEO of Hong Leong Bank. Khairul Abdullah, CEO of Axiara Digital Services. Mario Aquino, who's the CEO of Future Labs. He's also another Chicago alum. Rob Sewell, who's the CDTO at Maxis. So stay tuned. I think the next session is next Tuesday at 18th August. We've also sort of taken a little bit of a slower approach to our sessions. We're doing 2 a month now rather than 4 a month. I think I was on a sort of a super fast train trying to get more sessions, bring more people, but I think we'll slow that down. So as said, I think it's time to end this. It's about 7:23. Have a wonderful evening, everybody. Thanks for taking the time to join us. Peter, Ben, you can stay back, if you have any other questions for me and the Hong Kong team. And again, I couldn't have done this without the support of CK and Lenora, who's worked relentlessly in the background to make this happen. Thanks to them for this as well. Have a wonderful evening, guys.
Thank you.
Thanks, everyone.